Hey everybody, it's almost tax season, so let's talk about tax planning. Last week I uploaded a video about kind of what is tax planning, so now I want to make sure we have the information we need to be able to look at these situations and do some meaningful tax planning, making you as efficient as possible. So let's start with deductions. What are they? Well, if you choose to itemize your deductions, you get to go through and look at things like your mortgage interest, add all that up. They give you a little tax form that tells you how much in mortgage interest you paid. Keep in mind, home equity loans you cannot write off anymore, and mortgage debt up to $750,000 worth of debt, the interest on that debt, you get to write off. Charitable contributions, you're limited to 60% of your income, but I've only seen somebody hit that limit once in my life, and you can carry over the difference. Medical, the first 7.5% of medical expenses, so 7.5% of your income is reduced out of the medical expenses. So you got to have a lot of medical expenses in order for you to be able to itemize that. All right. And then state and local taxes is limited to $10,000. And if you were in a federal disaster situation, if you had losses from a hurricane or something like that, you can write those off as well. So you're very limited on what you can write off. And we find most retirees, the vast majority of them, unless they had a really big medical expense here, they don't itemize, because this is a choice of either or. You either choose to itemize because you're saying you have more than the standard deduction. And now we look at these standard deductions and say, holy cow, we got a lot to write off here. Married couples for 2023, $27,700 is what you'd have to come up with itemized deductions to beat this. And if you're over 65 and married, you get an additional $1,500 each. So that's another $3,000 on top of the $27,000. That's $30,000 you automatically get to deduct if you're over 65. That's a lot. All right. So that's why we don't itemize. I don't even itemize anymore. The vast majority of people don't itemize anymore. So keep in mind, when you're saving all those receipts, this is the dilemma. If you don't have 27, or if you're over 65 and married, $30,000 worth of deductions, it's not worth saving all those receipts. Single people, $13,850. And if you're over 65, an additional $1,850 as well as that standard deduction, right? So that's the deductions. So you have income, you take away those deductions. We happen to have something called above line deductions. Before we choose to itemize or take the standard deduction, we get to take these away from our income. It's kind of cool, okay? So this includes a special line for teachers, because teachers pay for a lot of their own expenses. It's absurd. I don't understand how it happens. Now they have to, go send all the kids home and say, this is our wish list. I wish we had this stuff in our classroom. So classroom expenses, teachers' expenses that they're not reimbursed for, they can write off there. If you put money into an IRA, this is where you write that off. You get to deduct that to make it pre-tax money. Student loan interest, tuitions, the health savings accounts. This is where, when you're putting money into these plans, when you're paying off student loans, this is where you're going to write all this stuff off. Military is the only one that can write off moving expenses now. There's some self-employed and tax deductions and health insurance tax deductions there. Self-employed plans like SEP IRAs you deduct here. Early withdrawal penalties, and some domestic production activity stuff that doesn't apply to really anyone. All right. So these are called above line deductions. Got income, take off those above line deductions. This is how we come up with our adjusted gross income. Then we choose to itemize or take the standard deduction. We eliminate that from the income, and then we have to start paying taxes. So our federal income tax rates are right here. The brackets expanded quite a bit this year. This is a good thing. This means less taxation, believe it or not. We didn't change tax rates, but we're going to have less taxation because they made each bucket bigger. We only pay one bucket at a time, okay? just as you look at this chart here, you've got for an individual person, you've got 0 to 11,000 taxed at 10%, from 11,000 to 44 taxed at 12. If I had $44,900 in income, that doesn't mean I pay 22% on all of it. Okay, I only pay 22% on the couple dollars that went over, that spilled out of that 12% tax bracket. So keep in mind, when you look at this, it's really important that you understand we've taken off the standard deduction from your income. So you could have 60,000 worth of income and still only pay 12% as a single person on here, okay? Because you've got that big standard deduction. That's the important part that we've got to pull away from the income that we had throughout the year. So notice we jumped from 12% to 22%. When I talk about being as efficient as possible, for a lot of retirees, that means staying within the 12% tax bracket. And for married couples, that's $89,450. And that is after you've reduced the income from that standard deduction, which, remember, if you're over 65, was $30,000. So add 30 to 89, round it up to 90, that's $120,000 a married couple could have before they have to worry about paying 22% taxes. Okay, almost all forms of income are taxed right here. Okay, you got W-2, self-employed profits, rental profits, interest, pensions, IRA withdrawals, required distributions, short-term capital gains, non-qualified dividends, and up to 85% of your Social Security. It's all taxed right here. But that standard deduction we talked about is really big, and we get to pull that out of our income. So 89,000 for a married couple, 44 for 1,000 for a single person may not sound like a huge amount of money, but then you bring in that standard deduction and $120,000 and $60,000 for a single person is pretty darn good at 12% or less taxation. That's where the efficiency comes in. We got to know those breaks. We got to know where we hit 22% and make wise decisions on what we're doing after that, because we do have opportunities. Okay. First thing we need to know, right down there, there's a little asterisk with a 2026 tax rates. On the books, the way it is, these current tax brackets are temporary. They always were temporary. When they were put in place, they were temporary on purpose. Okay, so in 2026, 10 stays 10, but 12 goes back to 15%, 22 goes back to 25%, 24 goes to 28, so forth and so on. So the tax rates will go up. 2026 is when it happens, and that's if nobody does anything. And we know how good they are at doing nothing. Here's our tax advantaged money right here. Qualified dividends and long-term capital gains are taxed on separate taxes. Okay, I have a whole separate tax bracket for long-term capital gains and qualified dividends. So what are those? Qualified dividends are U.S. corporation stocks and a couple of foreign stocks that meet some qualifications. Usually big multinational companies that have that are trading on our stock exchange. So qualified dividends are U.S. stocks. Okay, you got to hold them 60 days before and after. So there's a 121-day holding period, 60 days before and after that ex-dividend date. So it's important to know that if you're buying, you might be within that 121-day window, and that first dividend might be non-qualified, but the rest of them, if you hold it, will be qualified. Okay, so any buying and selling that goes on 60 days before or after the dividend date, those will be non-qualified. Everything else will be qualified. That is your qualified dividend. So one thing you got to stay away from is these actively traded mutual funds. You're going to see a lot of foreign stocks in there trying to create yield. They pay higher yield. That's why these mutual funds will buy them, but they will also sell them right after the dividend is received. So careful, that's how you're going to unqualify your dividends, by owning these mutual funds that tend to buy and sell. Then there's the long-term capital gains, a lot easier. That's just buying an investment, holding it for a year or more, and selling it. If you sell it for a profit, that's a capital gain. Okay, long-term is more than a year between buying and selling. You look at these tax rates. $0, not percent, to $44 is taxed at 0. The thing I want you to understand is that's total income. So that's not just the dividends separate from your other income. So if you had $50,000 worth of regular income, then you're going to go to this tax bracket and start at $50,000, which means you're going to pay 15% on your dividends here, okay, on a single person's tax. But still, 15% is great because on the full taxation, it would have been 22%. So you're paying less taxes here. If your total income, factoring in that standard deduction, if your total income is less than 44, then the dividends and long-term capital gains are tax-free. Total income includes the dividends and long-term capital gains. Don't worry, on an upcoming video, I'm going to break down some examples of this and show you how that taxation works. I just need you to understand when you're paying 12% on the regular income taxes, you're paying 0 here. When you're paying 22 on the regular income taxes, you're paying 15 or 18 here. It's important that we understand qualified dividends and long-term capital gains are at much lower tax rates, if not completely tax-free. That's a great thing. And anybody that's putting a portfolio together needs to understand this, because their choice of investments with your after-tax money will absolutely, unequivocally be influenced by this taxation. This saves you lots of money, and this is part of creating an efficient portfolio, okay? If an advisor says they can't talk to you about taxes, but they're picking an investment in a portfolio, they're probably going to start causing you extra taxation. And I don't think that's fair, because they should have no problem with their knowledge of taxation talking about it in broad sense. They can't tell you how to, what deductions to make and the nitty-gritty details of a tax return, but certainly the 10,000-foot view from a financial planning perspective, they should be on top of that. It's so important when it comes to your portfolio and creating this efficiency, okay? All right, hopefully this helps. Keep an eye on this, because next week I'll put another video out. We're going to have 3 or 4 more videos on taxation because it is something that is incredibly important when it comes to your portfolio in retirement. Hopefully this helps. All these updated tax rates will hopefully be able to take advantage of some of this. We got to pay as much 12% as possible. That's a hint on some of these upcoming videos. We want to choose to pay as much 12 because higher tax rates are coming. Let us know if we can help out. Shoot us an email, give us a call. We're available nationwide via Zoom. We have clients all over, and always happy to help out in any way that we can. Subscribe if you haven't. We're putting new videos out every single week, and subscribing will help you keep up with those videos and keep up with your knowledge as well. Hope everybody's doing well. We'll see you next week.